Hello, everyone, and welcome to O'Hare Wealth Management's weekly update for the week of March 5th, 2025. I'm Jerry Jones, joined by John O'Hare III. JJ and I are going to talk to you about items related to the market, financial, otherwise, and questions that we've received from clients and/or prospects on a financially related basis. However, we do have a new twist this week. JJ, you want to tell them about it?
Only a slight new twist. So we are switching permanently to YouTube as a home of these calls instead of Zoom. It's going to give us some new capabilities and some different abilities to interact with clients that we weren't able to do with Zoom. And with some people being mobile, it's even more important for us. So
And we think, given that, the capacity for us to do more on these calls will just be more enhanced. So sit back, relax, enjoy this time. And with that, as always, if you have questions, please submit those to service@oharewealth.com. Thank you, sir. Or you can text us, if I move out of the way, at 414-644-0060, and we will make sure and include those on our next call. With that, as always, a lot to unpack this week, and we're going to turn it over to JJ with our first question for the week. And the main thing we're going to talk about today: what does last week's personal consumption expenditure PCE number mean for your outlook?
yeah, for us, this question, I got a lot of questions this week. Stagflation, which I think we'll cover next week. I got questions about corrections. And this one I think was kind of encompassing of a lot of things we are trying to talk about. So we chose this one. So what is PCE? First of all, it's an inflation measure that the Fed uses, and it's their preferred measure. And it's usually a little bit lower than CPI. CPI is the one people I think are more familiar with. They've heard that one a lot. This chart, if we can zoom in on that real quick, with the full screen tab. This is CPI versus PCE, and CPI is traditionally a little bit higher. But why is that? Well, it's a very easy answer. Is PCE adjusts, CPI doesn't. So CPI is revised every once in a while, but it's a different measure than PCE is, and they have some more volatile components in there. If you look at this next chart very quickly, CPI versus PCE, they're weighted differently. Food 15 versus 13, not that different, but housing 32% for CPI versus 15% for PCE, or healthcare 9 versus 21. Those are some pretty different weightings. And really, if you wanted to summate this in total, what's the difference between PCE and CPI? PCE adjusts. PCE assumes that if you don't do one thing, you do something else, right? If beef is expensive, you buy more pork. CPI doesn't do that. CPI says you spend the same amount of money basically year over year. CPI was developed in 1921. It's not as effective as a measure, in our opinion, and in the Fed's opinion, as the PCE weighting. So we want to focus on the PCE, which came out last week, 2.6%, which I think the market was a little shocked by because it didn't go down. Now it didn't go up either. It's 2.6% is basically the year over year number. It's kind of seemed to be deadlocked in place, which would mean that the Fed might not want to lower rates because they want to see more progress on inflation. And that is one of the questions. What is PCE doing to that number? It means the Fed's probably not going to be in the hurry to lower rates. We got a lot of numbers in the past week or so. I mean, manufacturing data was positive for the first time in a while at 50.9. And to put that for reference, the ISM manufacturing, the ISM services numbers, is out of 100. Anything over 50 means you're growing. Anything below 50 means you're shrinking. So that was growing. So I know a lot of people have talked to me about a manufacturing recession in this country. Well, last month it was growing. Services came in 53.5, even hotter than expected. So services are growing. And remember, this is very important. Services are over 70 and close to 77%, depending on the weightings and how things are moving, of our economy. All right, manufacturing's only about 7% now. And we talked about this a little bit in our market outlook. I think people still have in their mind that it's like a third to half of this country is manufacturing. No, it's closer to 7%. It's a relatively small amount, which, we're going to have another conversation about tariffs and GDP. But it's why, manufacturing, those numbers, manufacturing recession doesn't take the entire economy down. We've had many numbers below 50 for manufacturing since COVID, and the economy's grown basically all that time. Well, that's because most of the economy is service-based. Really quickly, talking about interest rates. So the Fed, right now we're inverted on the yield curve again. What is inversion? Well, 4.3% basically on the 3 month or the overnight rate, and we're at 4.2% on the 10-year. Now, traditionally, when you talk about inversions, you really want to talk about the 2-year and the 10-year. We're not quite there yet, but the very short rate, which the Fed could always adjust, is currently inverted by 0.1%. What does an inversion mean? An inversion really means that they expect things to be lower in the future. And key is, what does the bond market expect to be lower in the future? Inflation. And why would they expect inflation to be lower in the future? They expect inflation to be lower because they expect lower economic growth than was previously planned for. And by the way, I don't know if you saw this, but the odds of recession on some of the betting markets shot up this year, or really just in the past couple of days. And the Nasdaq, is down 10% from the highs earlier this year, and I think the S&P is down through yesterday, like 6.5.
Yep.
So the market's a little bit scared. Why? Because we came into this year expecting 2.6% on GDP in some cases. Some people are saying 2.3. If you remember our market outlook, we were talking more like 2 and 1.8%. And back then, we also didn't know what our tariff policy would look like. And if you want to talk about tariffs, I don't know, it's sort of like the weather in Wisconsin. Wait 5 minutes, it'll change. Can't seem to get a great handle on what's going to happen differently with tariffs. So, look, by the time people see this video, the tariff policy could have changed 3 or 4 more times. Tariffs look like they're going to have an impact. Our postulate is still, because it's on things like steel and aluminum and some agricultural goods, a lot of manufacturing. Manufacturing just isn't a great enough percentage of the U.S. economy for those to be a single derider. But can they absolutely slow GDP down? Yeah, of course they can. And they can create uncertainty. And anytime you create uncertainty, even without any other major factors, uncertainty itself can cause problems, even if you don't know. So if you don't know if you need to hire people for next year, or if you are in the middle of a contract and you think it might get canceled, well, it calls into question, well, if I think the contract I have might get canceled, well, do I hire people to help me fulfill the contract, or do I wait? Do I buy the necessary equipment to do it? And suddenly there's all sorts of series of uncertainty that can be problematic. So the market likes certainty, not uncertainty. It grows best in certain times. So for us, when we're looking at the inversion in the yield curve, yeah, it says the Fed probably doesn't want to lower rates right now, but PCE would say they shouldn't need to. But the bond market is saying we should be expecting lower GDP than we came into the year with. So I don't want anybody to be surprised. That is part of that question right now, is what is it going to look like. So earnings expectations on the S&P 500, I saw some that were like 20, 30% growth. We were expecting like 11. It might only be 7 or 8. And so, those lower earnings expectations would probably lead to lower overall returns. And we said at the beginning of this year, we thought it'd be a tough year to make money, but that's just another thing that would add on top of it for being a more challenging environment. On a 5-year basis, it doesn't matter. And it doesn't matter for this reason. We have corrections every year. Right now, this chart's a couple days old, and it says we only have a 5% correction. We're currently over 6%. We have corrections every year, and people forget about them. Last year was a great year. Everybody remembers a 20+% return. There was an 8% correction intra-year. There was a 10% correction the year before that. Right? There are a lot of years we have big intra-year corrections, even though you end up much, much higher at the end of the year. So people say, well, we're down over 6, we're down 10% of the NASDAQ. Is this a correction? Is this time to buy? Is everything over? Is it all going to end? You have to remember, we expect every year to have a 14% intra-year correction. We're planning for it. So we haven't hit 14% yet. 10% is a correction. 20% is a bear market. And if you remember, we've talked about this in the past. Where do those numbers come from? We made them up. It's just what we all decided. 10% was hurt and 20% hurt really bad. So when you look at what might happen this year, is the correction over? I don't know. I mean, there's a lot of uncertainty in the market right now. We could easily see a period where this continues to persist. And it's a question of what kinds of stocks are being purchased and who's selling them. So if you get a lot of selling because of uncertainty, well, a lot of the big winners for the past couple of years, and we talked a lot about this during our market outlook, there are a lot of mutual funds that are overweight certain equities, and those are also usually their best performing and most liquid equities. And if you get redemptions and people want to take their money out, those are the things you sell first, and those are the things that then probably get hit the most. It's for every there is an equal and opposite reaction here. There is for everything that goes up, it becomes more risky, right? It just is. So whenever you look at the intra-year corrections, try not to get overhyped about it, because you can have them and still have a great year in the market. And by the way, on a 5-year basis, because every time you buy any stock, you should be thinking about it from a 5-year basis. You have a lot of corrections over the past 5 years, and we just talked about this recently. But it's it's early March. If you rewound 5 years ago, almost exactly, people were still making jokes about how COVID wasn't going to be a big deal. And I was in the hospital with my second born at the time. They didn't even make us wear masks, and they basically had to ask us a requirement if we'd been exposed to COVID, even though at the time I think it was like 6 people in the state of Wisconsin had been diagnosed officially. Well, guess what? You're about to spend the next 5 years with a 34% intra-year correction, and then another 25% intra-year correction, 2 years later. But over that time, you made a lot of money. So you really want to make sure you take this cautiously over a 5-year period. Even buying at today's levels, which would have been right before a slip of almost another 30%, looking back 5 years, it all still looked pretty brilliant. So remember, it's time in the market, not timing the market. But that's the major question we're going to answer today. Want to try to cover, I think we're going to cover a couple of different things next week.
Yes.
We're going to try to keep these calls a little bit shorter, but let's go to the book recommendation.
Yes. With that, Good Energy by Casey Means. I'm about, I'd say, a quarter of the way through the book right now. Very useful information. I would highly recommend it. And I know, JJ, have you finished it yet? I know
I'm almost
your dad
done.
has.
Yeah, he was the one I wanted to put on the list. So.
Okay, good. But I think, given it's the beginning of the year, we all try to start off on a very healthy note or get ourselves to a very healthy state. And we have all the energy at the beginning of the year. We wanted to put this forward early in the year. And I really think it crystallizes some very key points along the way. I'm early once again into the book. John will talk a little more about it next week as he's completed the entire book. But once again, this is highly recommended. We do know that a lot of you talked to us about our book recommendations, and proximity was the last one. We've had a lot of inquiries about that, as well as our what we call the refrigeration book, because those are stats that people just love to talk about. So we'll keep these coming, but if you would like something from us, JJ, there is a way they can get that online now, correct?
Yeah, so it's on the sheet there, Goodreads. It's actually an application brought to us by Amazon, but we're going to start adding all the books on there. So if you follow us on Goodreads, you'll actually probably see what we're reading ahead of us recommending it. And then also, if you want to go back, because every once in a while somebody says, hey, what was that book you recommended 2 years ago? And my answer is, 2 years ago when, and what was it about? You can actually look it up on Goodreads and probably find it yourself pretty easily.
Excellent. With that, I think we are at the end of this week's call. We do always appreciate your time and always your attention. If you have someone that you would like to recommend to us to further have a discussion with our team about what we do and how we do it, we always welcome those inquiries. So please feel free to share these with friends or loved ones that you feel would benefit from our services. On behalf of JJ and the rest of the team, I'm Jerry. We'll see you next week.
Thanks, everybody.